Welcome to the Collateral Base, where we discuss security interests so that you can bank on American business. Today, we discuss the quintessential security interest relevant to commercial business, that is the commercial mortgage. And this is extremely important right now. It is so hot out there. They are raising the interest rates. Everybody has a job. The collateral base is high. However, I was reading today in Barron's. Let's start with a quote from Jim Paulson. He's the chief investment strategist with the Leuthold Group, and he says, one gauge of recession risk, with a pretty good track record over the past 50 years, the investment-grade credit spread just flashed a recessionary warning sign. This less followed indicator should not be ignored. What happened was the investment-grade credit spread has gone above 2%. If you would like to read a Bloomberg article on the same thing, it is found in the content or the description section if you're watching this on YouTube. I'm going to assume, for the principles of this discussion, that you are using, and by you I mean your financial institution is using, a Laser Pro or a standard form provider commercial mortgage. The first term that I really want you to turn to and make sure, especially if it's one of those loans that you're not too sure about right now when times are really good, look at the cross-collateralization language. That cross-collateralization language is enforceable in the commercial mortgage. However, there's a few things that you need to know about it. Make sure it's really, really conspicuous, that it's there. Make sure the definitionals of that cross-collateralization are in there really, really nice. There's one definitional we're going to talk about at the end, but the other ones need to reference all the other notes that that borrower may have or have in the future. And that cross-collateralization language puts other creditors on inquiry notice, which is important. We're talking about, and this will be in our case law update series. It's case about 5 years old now, but it's still very good, very, very prescient. It's a very important case. People's National Bank versus Banterra Bank case from the 7th Circuit in 2013 dealt with such cross-collateralization languages. So important. We'll be coming back to the cross-collateralization languages at the end. Another extremely important, especially for enforcement of these mortgages, if the loan which was made good at the time for some reason goes bad. Doesn't matter why. You just want to make sure that if that happens, you are going to mitigate the damage to the bank. That is the safest and soundest thing to do. And the way to do it, and the way you do it in Illinois, is you make sure that the waiver of the right of redemption, not reinstatement, but redemption, is in the mortgage expressly. Make sure all your commercial mortgages have a waiver of the right of redemption, because you do not want to be waiting 6 months in foreclosure when you could do it substantially faster and cheaper than that. Net present value of money, you know that. Reinstatement, that's up for you. That gets into another point that we were just discussing at our most recent Illinois State Bar Association's Commercial Banking and Collections Section Council meeting. Do you need a deceleration clause? The acceleration clause, it's in every commercial mortgage that you're going to get from like a Laser Pro or another form of mortgage provider. The acceleration makes the entire indebtedness due. There's probably also going to be a waiver of the right of reinstatement in that mortgage. Let's assume you have to foreclose, and then the debtor, through some stroke of luck, because times are really good and maybe he was just ignoring the bank. Sometimes commercial debtors just do that. They do. Boom, he's able to make the entire indebtedness current, paid every dime, including the attorney's fees and all the other costs of suit. Great. The bank then would have the opportunity, if they so desired, to, especially if that waiver of the reinstatement is in the commercial mortgage, they would have the opportunity to say, okay, we want this reinstated. That's where the equities are. I could see it being difficult for the bank to say, no, we aren't going to reinstate, even if the waiver is there, because a judge would look at you and go like, what, do you just want to take the stuff? I mean, I thought you just wanted the money. Banks usually just want the money. Do you need then a deceleration clause in your mortgage for future defaults? If the mortgage has already been accelerated, the promissory note tied to the mortgage has already been accelerated, can it then slow back down in the case of reinstatement? This can be handled in drafting. Any such reinstatement is going to be judicial, and so your counsel absolutely needs to have a order that says this proceeding is dismissed pursuant to reinstatement of the mortgage by borrower paid in full on such and such a date, because in the Illinois mortgage foreclosure law, you need that date. It matters. A borrower is only entitled to one reinstatement every 5 years from the date of that particular dismissal by the reason of reinstatement. Some type of documentation should be in the mortgage so that you can have a subsequent default. So you're not suing for the original default. I mean, you accelerated the indebtedness. Now the whole thing is due, but then because of the operation of the reinstatement, you're saying that now everything's normal again. It's like as if the default has never happened, and that might be something that is already, read your reinstatement language very carefully, so you're not going to have any type of problems with decelerating the acceleration and then creating a subsequent default thereafter. This might be a little too hyper-technical. Courts are exceedingly technical sometimes, but then very practical other times. So before we return to the cross-collateralization language and a related definitional, if this is your first time joining us on the Collateral Base and you're enjoying the content, please consider clicking subscribe, give us a thumbs up, and if you have any questions about your Collateral Base, you can leave it in the comments, or you can hit us up at collateralbase.com. We are here to explain security interests so that commercial banks can continue their mission of providing the lifeblood of the American economy to small businesses. Not sure if you know this, but community banks provide the majority of small business loans. So to protect those lenders, let's now talk about the maximum indebtedness clause that you need in your commercial mortgage. This ties back into your cross-collateralization clause, and it operates as inquiry notice to the most amount that a borrower may be on the hook. It also helps the bank make the best recovery, especially if there are other loans that are out there and the debtor has tried to play his various loans to avoid having a secured loan. Safest procedure is to take the amount of the original principal and double it. So you're going to have, it's $1 million loan. Your commercial mortgage will have a cross-collateralization clause that is conspicuous. It's going to be in caps, bold even, and it's going to provide, up to the terms of the maximum indebtedness. Flip some pages, you're going to get to the definition sections, and the definition will have maximum indebtedness $2 million. And cross-collateralization language of the commercial mortgage will make sure to take all of the notes, letters of credit, other obligations that the borrower has at the bank, and ties them all together. Thank you very much for joining us on the Collateral Base, and we'll be seeing you with another security interest question really soon.